Today we're talking about a student that made $2,900. That means he had 10 winning trades, he had 2 losing trades. And the interesting thing is that even though if he would have 9 losing trades and only 2 winning trades, he would still make money, because we use something that is called the risk-reward ratio. And the risk-reward ratio means if I have $100 that I use for one trade, I'm trying to get out $500 for each trade. That means if I have 2 winning trades of $500, I'm making $1,000. But if I have 9 losing trades of each $100, I lost $900, right? So in total, I would have still make $100. And this is how trading is more sustainable over months, over years, than trying to succeed with 10 winning trades, just 2 losing trades, just as you see here. But this is from a trader that has already 3 years of trading experience. And I think it's just very nice to see, to show you something what I traded, because I just came back from vacation. And you can see here how I made here $326.30. I accidentally traded over the wrong account over this YouTube channel. I'm sometimes going live trading a Top Step Trader evaluation to use $50, $70 a trade. I'm trying to get $400, $500 a trade out each time. And you can see how I had here one winning trade of $459. $459.70. This was the winning trade. And you can see how on average I'm losing for these 3 losing trades $44. That means my risk reward ratio is 10.34 from average loss to average winning. What is actually interesting, and you can see here my profit factor is 3.45. The profit factor means if I lose $133 in reference to how much money I made, this is the profit factor. The profit factor should be at 5. I think 3 is okay starting to trade with real money, but it would be good if it's a 5, a 6, a 7 here. With the second winning trade, we could get this out here that this is a profit factor of 5, by the way. Okay, I'll just show you how it works. The thing is, a very big problem is with trading to learn how highs, lows, structure works and other things. But actually in trading, it is mostly about, here I have my $1,000 or $2,000 divided into 20, 30, 40 trades. And how do I need to shoot in the market, either a buy or a sell, that I make more money than I'm losing with quantity of trades? That means, can I make $100 and maybe lose only 20? Or can I make $500 and lose only 50, 60, 70, 120 or whatever, right? So here you can see, and this is something that is called a trading plan. The one thing is to understand the fundamental. Like if you see the market was up here, for example, at the time, I saw that the market had here a lot of candles. And very often when you look at the market multiple times, especially if it's always the same market, what is very cool, you see here that there's this consolidation phase, this is called. It means it shows us that you need to imagine that when you have a consolidation phase, it means always that people are in their positioned. That means, I'm going to draw you an example. If you can see here that the market is, let's just make this one black here, and then I'll just show you what I mean. If you can see that the market is going up like this, right? Like this. You have here always these stations. And you need to imagine that people sold here and people bought here. Especially if the market goes up, what is very interesting, people that bought here will have massive pain if the price go under this line here, because they also have something that is called a stop loss. A stop loss is if you see that the market goes up, for example, you can say, I'm seeing the market is going up. I'm seeing the market does this move and coming back, and each time it comes back, now I want to enter the trade and I want to adjust that if the market goes down here, I'm going to lose $100 and I'm not going to lose more, but then I'm not going to be in my trade anymore. But if the market is going in my direction, then I'm making $500, $600, $700 or sometimes only $200 because the market is just not pushing enough, because we see it often, very often, right? So the thing is, you need to imagine that people, when you have here a consolidation phase, these phases are where traders are positioned. And when you see them, what the market does very often, it will spike back and test like, does people still want to trade there? Or does people have pain there and wants to still that the market goes more up, right? So each time you have a consolidation phase, what is very interesting, and just like a lot of candles, the market likes to test it back in the past. Like in this case, we are up here right now, and then you can imagine that the market wants to test back here. And this was exactly what my trading plan is. If you have a market like the S&P 500 futures, because they're the 500 biggest companies, and it's very interesting concept, because when you look at Microsoft, Apple, Amazon, for example, or even Google. These companies have their own chart and they don't have a new all-time high. It means they are falling right now. And then when you look at the S&P 500, it is raising right now. And the thing is, because it is called the S&P 500, it will also fall down. And this is something what is very interesting, very important to understand, is that this market is very nice to trade because it gives you absolute facts that the S&P 500 is nothing else than just the 500 companies inside and a combination of all these markets. And if you see the major markets are falling, but the S&P 500 is rising, I would not consider actually assuming that the market will still go up, because this is something what is technically just impossible, right? So what we see here right now is the S&P 500, and you see how there is this consolidation phase. The thing about Microsoft, Apple, I'm not going to show this in this video because a very big problem is people are going to look at that and then say like, oh, Microsoft, Apple is falling, that's why the market needs to fall right now. It is more like a tendency, it's like a help that you know exactly the S&P 500, it cannot shoot up like crazy and we can position ourselves like for 5 days or something. But here on this channel, we do more day trading. That means we're sitting ourselves down within 1 or 2 hours. We trade and then we're finished. This is something what's very important. And the markets are just a help to see in just like if the market is pushing up or not, right? So let's just go back to the S&P 500. We don't need to use another market. What is very important? Just the S&P 500. And when we can see here this consolidation phase here, and the market is up here. Once the market starts to make a lot of red candles that you see here, a lot of red candles, and you see it through multiple times that the market wants to go back to the consolidation phase, then it's time to use the trading strategy. Because in trading, it's first of all to build a relationship to the market. Where can you see the market is going at? And then once you can see that the market wants to go down here, because you saw it multiple times, maybe out of 10 times, it only works 5 times. But that's already way enough, by the way. Because now we're coming to the money management thing. If you see 10 moves, okay, like 10 different kind of trading days, and you are seeing, oh, I see the market is going back to this position from here, from point A to point B, right? Because we have here this consolidation phase. We have here, for example, just like here how the market was going higher here, and then we have here the current point right now. And we see within 1 hour that the market moves from here to there within this length, that within the next hour, this move is very realistic. Either it goes down within 1 hour or it goes up within 1 hour, right? So this is the most important thing about trading, is that we need to build a relationship to this one single market. And maybe out of 10 days, it happens only 5 times that the market was going down. But then the other 5 times, the market was going up. And this is something that's totally fine. Now you need to understand about money management, how to work with money. And it means if we have, for example, $1,000, we divide this into 20 trades, so that's $50 a trade, for example. It's just a round. Sometimes it's going to be 45, sometimes it's going to be 65, right? We cannot adjust always $50 an average, but it should be just an average. The thing is now, when you see that the market is going down and you're trading now down, and we use now $50 for the trade to make $250 or $300 an average. Okay? Let's just use, instead of this one, let's use $1,000 and let's just use 10 trades and $100 a trade, because this is easier to calculate. But for the money making thing, I think $50 is something decent for a beginner. We use now $1,000 divided to 10 trades, and we use $100 to make $500 here. Now check this out. If my rule is I'm only allowed to have 2 losing trades a day, what happens is that if it's Monday to Fridays, right? Monday to Fridays, for example, those are 5 trading days. That means I have $1,000. I would have lose $1,000, for example, because if I lose every 5 days, Monday to Friday, selling, for example, 2 times, if that's my rule, I lose maximum $200 an average a day. I would have reached $1,000 after the 5th day. But here's the thing. It is very important to understand that the market is running each week and each day and each hour differently, even within each 10 minutes. And this is why a trading strategy should help us more in identifying every 10 minutes. You want to have an entry signal. Either you can buy, you can sell. That it's not the trading strategy itself too much you're trading with, like, I need to enter now my trade because I have this confirmation. Trading is more like, I can see the market is going down. I can adjust $100 to make $500 to our goal. and I'm allowed only to have 2 losing trades. Now, if you have, for example, let's assume like you have, for example, 10 winning trades, and you have 10 days, for example, you're trading, and you have 5 days, you can see that the market is going really in that direction, and 5 days you're losing. Then just imagine you're making 5 times, for example, on the 5 days, you have each time only 1 winning trade of $500. That's $2,500, right? Like that's actually amazing, because we're talking about 5 times $500. That means you can lose now 25 times $100. That's amazing, right? That's just the calculation thing. On the practical side, it just looks different. On the practical side, it is out of 10 trading days, you will maybe able to see it maybe on 2 days that the market really wants to do this move. And the other 8 days is more like, I can see it maybe. It's more like a guessing game, and you will always get better and better on it, because you're always looking at it with the market time. Always the same pattern, like what makes sense, not just a pattern that you see from the book. I'm talking about like you understood that the market has your traders inside, that when the market goes up, it wants to spike back. And once you see here a lot of red candles, you can see that the market does it. Then we go into the trading strategy. Now, how can I adjust $100 to make $500? But you first want to see out of 10 trading days, like really, and what day were you able to see better that the market goes down or less frequent? And then it goes on with the trading strategy. So now here's the thing. If you're able just to have 1 winning trade, this is something that's very important. This is going to be $500 in average. Sometimes it's maybe 450, 400, but then you're losing maybe only 60, 70, 80, 120 or something. And the thing is, then you can afford yourself 5 more losing trades, or even up to 7 losing trades for just 1 winning trade. And to understand is also that we're not going just to punch in always 2 trades and then finish next day, 2 trades, finish next trade. It's always about like you see like 20, 30, 40 trades a month. That means within 10 hours of your time or 15 hours of your time investments, you're seeing 20, 30, 40 trades opportunity that are working and that are not working in combination. I'm going to show you something as an example. You can see here from a trader. He, for example, he saw 37 trades he saw within 1 month. Out of 28 trades that he saw, within 28 trades, he had 9 trades that he traded. That's why he saw 37 trades. And then you can see how he had 8 winning trade and 1 losing trade. Each time he was adjusting $100, and each time he made $500 or even more. You have here the analysis. This is like what to read. Like, does it really make sense? And then when you see, oh, it works, placing that single trade, it works, and you can see how it makes you $250, $620, $560, or loses here $100 here. And this is like an average to make this Excel sheet. To just understand the money making activity is to build the relationship to the market, and then the straight trading strategy kicks in about like, what is a red candle? How does it work? Like, just to do so on. So for this trade to explain, I had here this consolidation phase that you see here. And very often when you see the market is pushing up this high, it will not reach here the biggest structure low, because either the market will aim for the biggest structure low or the biggest structure high in this case, or it will just have here a consolidation phase as you see here, and it will not manage to reach it because the pressure up is just too strong. But the thing is, if you are trading here only for 1 hour, for example, here we had 9 a.m. Central Time here, and then you're just like until 10 a.m. Central Time here on the computer for 1 hour. Look here, like the only thing you can trade is like from here to there, within if you're only within this time on the computer. And it's also the most efficient thing, because if you trade more than 1 or 2 or 3 hours, it's literally so hard to concentrate on, because you see 60 candles within 1 hour, and this is good. You see each 10 minutes, you see 2 or 3 entry signals, you can buy, you can sell, and it's all about how do you see the market, what is the relationship to the market. Now somebody can say, is this gamble? And I'm telling you, if you adjust here $60 and you lose $60, but you make $500 here, this is not gamble. This is like how trading works. You can see here, the average losing trade was $44. The average winning trade was $459. Currently, I am, this is the thing with YouTube, what we're doing here right now. And this is an evaluation I'm working on. And you can see here how I have 7 losing trades, how I have 3 winning trades. But here's the thing, I lost $53 on average, but I'm making $376 on average. Before this one losing day here, it was around, the average of losing and winning is really different. I'm telling you, actually, I'm a bit regretting that here there you can see, before it was $522 in an average for winning trade. and it's $55 for a losing trade. This one trade when I was on vacation, I didn't execute it over the combine. I was just executing it over the practice account while I'm showing you this one. And this is what I'm working at on the YouTube live. It's going to be 9 a.m. Central Time. Sometimes I'm live on this YouTube channel. And you can also see the recordings just on the channel. Hope you can also learn out of this one. So let's come back to the topic. The topic of this video is that the one thing is to learn trading strategies, but the other thing is also to understand what is my money-making activity. If I'm investing 10 hours of my time, can I really see like 20, 30, 40 trading opportunities and only pick the best? And of course, the more money a trader is trading with, the more with high quality is going to trade. For example, here you can see the one trader was like trading only, I think 9 trades within 1 month, and he traded almost every day, by the way. Like here, as you see here, this is 1 month, by the way, calendar week 18, 19, 20, 21. This was like 4 or 5 weeks here, as you see here. And you see here that the trader here just placed like 9 trades, right? But he saw like 28 trades also on top of that. And the thing is, like when you trade like with smaller amounts, of course you're going to go for less quality. And this is something what I think is very important. People try too much to be perfect in trading. Like they try to have like 8 winning trades, 1 losing trade or whatever. But I think it's more important to show like, hey, you can see that the market is going back to this consolidation phase because you saw it multiple times. Now look at the setup that you see, a green and a red candle. Is the red candle so small that when you see in reference to the move and you adjust $100 that you can make $400, $500, $600, $700 or not? And then if that's the case, then taking the shot, taking another shot. And even though having so many losing trades, we're talking about 5 losing trades, losing $100, like $500 in loss, still having these 2 winning trades of $500, still making $1,000, so minus the 500, it's still $500 in profit and still making money in trading. I think like that fits to the majority of people trading is, and also long-term, not burning out, is to have something sustainable they can just do. By the way, we have a free community. Just join up under this video. See you on Discord. I love good trades. JT out.